got Natasha on the line. What do you want to ask her?
I guess the first question I want to ask you is, what do you think you could have known that would have got you moving faster when you started?
I wish that I had gotten involved with more networking groups.
Mm-hmm.
I didn't go for like the bigger networking groups. I went for more of maybe the smaller groups, or it was also when I really got involved, and it was more beginning of COVID. So it was sort of the groups that were meeting regularly on Zoom or what have you. Now that the world has opened back up completely to everybody at this point, I think more networking, more involving myself with other people that are interested in doing the exact same thing, that have very niche focus like we do.
Hey, I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different from everything else out there. I bring together new and aspiring investors on each and every episode and let the aspiring investors ask the questions that they need answered. And if you're an aspiring investor yourself, you probably have the same questions. So before you get to this episode that we have prepared for you, make sure you hit the subscribe button and that little notification bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe, and I'm very excited for today's show. We've got two amazing people on the line with us. And without further ado, I'll just introduce you to them. Natasha Dillon's our experienced investor today, and Martha Sandino is coming on as our aspiring investor. So, ladies, welcome to the show.
Thank you.
So great to be here.
Yeah, it's always nice when I can say, ladies, welcome to the show. It seems to be an industry quite dominated by men, and I think it's getting better, but really, really nice to have two amazing women on the line today. So, Natasha, start us out by telling us a little bit about yourself, please.
Sure. So I got involved in real estate investing in 2019, shortly after a few years of doing commercial finance. And we were really looking to expand our investment vehicles to our investors. And real estate was a topic that we had discovered. And then when we had done a lot of research and found multifamily, we just found that to be the perfect fit for what we were looking for. Still high yield, great tax benefits, and great investment for diversification.
Yeah, I think that's what attracts a lot of people to it. I think everybody has one of those three things. I think will pop out a little bit more. But I started investing in single family in 2007, and I realized really quickly that appreciation basically knocked me down a tax bracket every year, which was pretty awesome. But so you went from corporate finance into real estate. What was that transition like, going from corporate world to most people in multifamily are more entrepreneurial? But what was that transition like for you?
I've always done kind of entrepreneurial things since college, and it's always kind of been part of my bread and butter of how I've been operating. But when I got out of my MBA program, I started doing some consulting, and from there realized that financing was big for businesses, and I was already doing investment. So when we moved from corporate finance, which we're still doing a lot of commercial finance, into the real estate, it was just a different type of vehicle, because the commercial finance were going and investing micro lending loans into multiple different businesses across all different industries. Real estate, it was less transactional, bigger purchases, and we're dealing with tenants and toilets and termites, unlike what we were dealing with just moving money around. So that was a big shift, was physically going to the properties, going into units, seeing properties and seeing all of the issues that come with the hands-on component of real estate, but it's also what makes it a lot of fun. And we do a lot of value add. That's kind of our focus. So a lot of properties we see are not pretty.
Yeah, that is true. You mentioned something, reminded me of something. We had one of our passive investors. They were driving through the area where one of the properties that they invested in was, and they wanted to go look at it. And so we gave them the address, made sure they could find it. And they came back and said, wow, that is not a pretty apartment complex, and it made me laugh, because, it's like you try to make the property look as good as you can on the pitch decks and everything else. But when you're doing value adds, you start with something that looks a little bit rough a lot of times. So anyway, good. That's what you reminded me of there. And I thought that was funny. But so you're in the New York City, or Connecticut's where you're at. Where are the properties you invest in?
Probably a lot of people in states like mine, we invest out of state. We started our focus actually in Florida, sort of touching on what everybody teaches you to do, which is go to a market that's growing, that's large, that has a lot of job growth. So we focused in Tampa to start. We bought a few properties there. Since then, we've sort of transitioned out of that market for multiple reasons. One being just priced out. We weren't buying for appreciation. We were buying for cash flow. So we still are in the Southeast, but we've focused on a market in Alabama, and that's sort of been where we've been sort of hyper-focused lately.
Nice. Where in Alabama?
It's right outside of Huntsville. So tertiary market right outside of Huntsville, Alabama.
Okay, nice. Huntsville, Rocket City, is that what it's called? There's big NASA
that's their nickname.
presence there.
Yeah, they have a big NASA, they have big tech. The market we're in sort of has a lot of growth from Huntsville, a lot of growth from Nashville, Birmingham. We're sort of kind of in a pocket that gets a lot of that and then has its own market, if you will, its own sort of ecosystem.
Yeah. So tertiary markets, tell us why you like the tertiary markets, or that tertiary market in specific.
It's really that particular one, but I've also invested in others. A lot of reasons being the pricing, like I mentioned, a lot of cash flow positive, a lot of more mom and pop type of investors, a lot of groups that are having properties that still have a lot of meat on the bone, that we can raise the rents, we can improve the actual product. And then in addition to that, it's a market where we've determined there's going to be a lot of urban sprawl, like a lot of people moving out of the cities where they've been priced out of.
True. And I live in a tertiary area, and we're seeing a lot of that too. I'm in Idaho Falls. We're about 3 hours from Salt Lake, 4 hours from Boise. Neither of them are like super big cities, but if you look at who's moving to Idaho Falls, it's a lot of people from larger cities looking for more space, looking for quieter, less busy. And the city I'm in has probably doubled in population in the last 8 years. So we're seeing that trend across the country. And I mean, that's what you said is happening in that tertiary market. You got growth from Nashville and Huntsville and the other areas. So you find a tertiary market like that, you stick with it, is my opinion. But well, cool. Let's talk a little bit about one of the specific deals you've done. You can talk about a Tampa deal that you guys have done, or one of the newer ones, but pick your favorite one and let's hear about it.
Yeah, I mean, I guess while we're on the topic of this tertiary market, that this particular property we purchased there was a 71 unit, really bad shape. It was purchased by somebody who is living in the area, but from California, was married to somebody local, divorced, moved out, and sort of left the building behind and didn't really take care of it. So we were able to pick it up for a really low cost, needed new roofs, needed all the interiors done. It was a brick structure, so not much as far as structural work that needed to be done, but a lot of just appearance, a lot of updating, and also exterior stuff. We ended up power washing the brick, painting it white, renaming it, pulling down tons and tons of dead trees, resodding, just did a lot of appearance stuff for that reason. It was in a really great neighborhood. It was in a very desirable part of town, close to downtown. And we were able to bump the rents probably right away, $250, maybe some $300, but now we're at $450 bump.
Wow,
and
nice.
it's been just over a year. We purchased it last October. That's the type of stuff we like to do. But that first you asked me, that first walkthrough was a lot of cat stuff and clothes piled up in every bedroom. So now we have very, very nice tenants, cleaned it out.
I like the approach. I mean, curb appeal. A lot of people kind of have the idea of renovate the interiors and do as little as possible in the exteriors, but I'm a fan of an outside in approach. I mean, when you start renovating the exteriors, everybody sees it. When you renovate the interiors, the current residents, they don't see what you're doing in other units. So I think for a lot of reasons, for keeping your renewal rate high, and for attracting new and better tenants, I think doing exactly what you said, painting, power washing, painting, adding sod, removing the dead trees and all that good stuff. That's going to do a lot for attracting people to the properties. And just by itself, you're going to raise rents on the units. So
we raised the rents on the current units as well. So for a lot of those reasons, they stayed. Most of them stayed for all the updates we had done.
If you do all those updates to the exteriors, you can raise rents on in-place tenants a little bit higher than you would otherwise. So personally, like I said, I'm a fan of the outside in approach, and glad to hear it worked it for you guys as well. And you said $450 rent bumps from previous to now.
Yep.
Okay.
Yep. They were not charging much. we're just that market.
Number.
were at market, but they just were letting it go. They had low debt, whatever it was. So
I've had a lot of properties in tertiary markets, and that's the benefit to tertiary markets. I mean, there's some challenges in tertiary markets as well, but you can find these little places that are, kind of a mom and pop deal that haven't been managed well, that haven't had the rents raised. And it seems like there's a higher percentage or a better chance of getting those in the tertiary markets. So can get better yields, but there's also challenges. Now, have you guys had significant challenges on the management side because it's a tertiary market?
no, I mean, that was a big part of us going into this market, was making sure we had strong property management, and we have a great relationship with our property manager. He's actually found us several other deals with, kind of off market, but
Nice.
through him, yeah, we've have a really good relationship with him, which is great. And to your other point though, about that, like going back to the Tampa was very, very tight cash flow. We barely had any cash flow on those, but we had big appreciation. I sold one of the properties and we had a large appreciation. But the other part was the property management. It was difficult because we weren't a big player in the market. I had probably overall between a few different buildings, about 100 units. And we were small potatoes to some of these larger companies. So the relationship that we formed with the property manager in this market is sort of, at this point, I've turned down a lot of other areas. Like I'll get brokers sending me to, even within Alabama, send me here, send me there. And I really respect and enjoy the work with our property manager there. And I had a bad experience in another part of Alabama where, because it was a tertiary market, they didn't want to drive 45 minutes. But we were able to switch them out and find a strong property manager that just makes it work. Goes there a few times a week.
You nailed some of the problems that we've had. We've had a couple of property managers, and this is the tertiary market specifically. If they don't want to take the time to drive out to the properties, it's not going to get managed well. And that's some of the problems that we've had specifically on tertiary markets. We've sold off most of our portfolio that's sitting in tertiary. Got a couple more under contract right now, but there's definitely some challenges. But on the flip side, you can find some real hidden gems in those areas. So let's shift gears a little bit. And something I like to ask everybody is, about their why. Why you do this. So what is your big burning why?
Initially it was like a lot of other people, for that generational wealth, for the ability to benefit on the taxes, again, for our investors to provide a diversification and a high yield type of product. A lot of people like real estate just for the aspect of it being real estate. So that was an opportunity for us to offer something. But at this point, I just love it. I'm pretty obsessed with it.
Yeah.
Looking at deals, working on our deals, seeing how we can constantly improve, especially, the value add. It's been a lot of fun working on those and coming up with different type of floor plans, and not so much floor plans, but more of like how we're going to just improve each of the units. But the cash flow doesn't hurt, the tax benefits doesn't hurt, and so it's been fun.
Yeah, a lot of good reasons to do it. I think you once again, I've done this podcast. I think this is going to be episode like 350. And it seems like most people have similar desires. Generational wealth is always one of them. But I love that you love what you're doing. It's something that I noticed a long time ago that I'd sit, and this is when I still had a W-2. I would sit at night and I'd go through like the real estate listings. I'd look at the time it was like duplexes and fourplexes. That's as big as I could think. And when I realized that I was doing that no matter what, that was kind of like the first thing in my mind saying, I need to do something real estate. I need to pivot and do something real estate because I'm looking at it anyway. I'm doing it anyway. I enjoy it. But anyway, that was my side. Anyway, what's next for you?
So continuing to look for properties and purchase properties, hopefully in these markets, particularly this one market that we're in, Florence. But obviously we're being cautious too with everything that's going on and watching rates. We have a deal now that's under contract with seller finance. So that's sort of probably for now where we're going to go and kind of watch as everything kind of happens. And we're refinancing a property now, and because it was such a value add, since we got such a great deal, it works out perfectly for us.
Wow.
deal. So that's been good, but we don't want to be stuck in another situation that is not so positive.
Yeah, I've got to say, there's not many people who can say that they're refinancing right now, and it's working. So whatever you did in that property, you've done well, obviously, to be able to refinance it. Just curious, what rate are you refinancing at right now?
We're hoping that we can lock in a little bit lower with everything, but it's
Yeah.
in the low sixes right now.
Okay.
Yeah.
Yeah. And what was your rate prior to? I mean, are you going down in
threes.
interest rate, or?
No,
What
no,
was
no,
that?
in the threes. Yeah.
Okay.
We got a construction loan from a bank.
Mhm.
So yeah,
Okay.
we weren't doing the bridge to
Okay.
this is
Yeah.
Fannie.
Yeah. If you did a bridge to permanent, you might have a similar rate now, but bank loan to something more permanent, yeah. If it works for you, good on you. If you guys have created enough value, that's really, if you create enough value, the refinance are going to work. So, well, cool. Well, we're going to pivot a little bit here and talk to Martha for a second. So, Martha, welcome to the show.
Thanks for having me. Great to be here.
Yeah, absolutely. Do us a favor and tell us a little bit about yourself.
Okay. Well, fun fact about me. I married my husband the day I met him. I was 23.
Wow.
That's another story. You can ask about it. I'm happy to share.
All right.
But so we moved to California and have 3 daughters, bought a house, worked in corporate jobs, did well. And then my husband's very entrepreneurial minded, very capital sensitive. So he said, let's get out of other people's jobs and let's work for ourselves. We bought a business, restaurant supply company. I ran that very well for 20 years, bought a warehouse. When the youngest of our 3 daughters went off to college, our marriage fell apart. We couldn't keep it together. There's a good ending, but it's pivotal to how I entered real estate from this point of view. Because what he wanted to do was basically cash out. He said, let's sell the business, cash our chips in, you take half, I take half, have a nice life. And we had too many bad loans to actually cash anything out at that point. We got taken advantage of by some aggressive bankers. Couldn't get liquid. And so what I said to him was, if you can go back to your country, help me run the business with your advice and your expertise, I'll send you a wage. And if you need to find somebody else, go ahead. But if you want to come back, I'm still here. And I just released him. And the reason I did that, Brian, because at that time I got this, I believe it was a revelation from God, because it wasn't part of my natural thinking. It occurred to me that if I would just run the business for another 9 years, then the warehouse would become very valuable. It's a commercial property in San Francisco Bay Area. Yeah. And I just got this insight that it would be very profitable if I could just pay it down and hang on to it. So he thought it was a losing plan, but he didn't have another option. So he went back to his country and I started trying to figure out how to make it work. And right away, I found out that I could rent little warehouse micro spaces, small place, 5,000 square feet. I started renting out rooms the way that I rented out my house when my daughters were off to college, 200, 300 square feet. And I ended up in this little space renting out up to 8 to 10 different micro warehouses while I was doing my restaurant supply. And I was getting 3 to 4 times the lease rate for warehouse space. It was so much more profitable than selling napkins to restaurants that I just liked that very much more. And so I just kept building tenants, kept building opportunities, I was making 3 to 4 times the mortgage on the warehouse and getting it paid down, getting it refinanced. And as I was doing this, my husband and I actually reconciled. We got back together. We became, first we were continued as great business partners, but then we actually, got back together. And so we started managing everything together. So when COVID came, we were restaurant supply. Everybody stopped. COVID, California, like New York, shut down really hard. And all my customers were gone. So I didn't have anything that I had, they didn't want, and whatever they wanted, I couldn't find. But I started buying things that people did want, cleaning supplies, pivoted, had the best year we ever had for our restaurant supply. What was remarkable is that none of our customers, our tenants, ever lost a month. So I said, that's it for restaurant supplies. I need to do real estate. And so I told my husband, we need to buy more property, collect more rents. And he said, fine, but no more loans. I was thinking, mortgage on my warehouse, equity from the home. And he's like, no, we're getting old. no more loans. I didn't know there was such a thing as a non-recourse loan at the time, but I had in mind that I needed to. I heard the phrase of other people's money, and I had the inspiration for apartment complexes. And so while I was contemplating on how to purchase apartment complexes with other people's money, Instagram served up a great mentorship program that I joined. I like it very much, and I've been through that. And so now I'm establishing a brand. I'm interested in a deal acquisition because of just the background of my experience and being my own property manager. I understand a lot about these things. And so I'm getting ready to take down a property.
Nice. Very, very fascinating story. I like it. Not the typical, get out of corporate life that we get on the podcast, but yeah, fascinating. So the little micro warehouses, I love the idea. It's basically what a lot of people do. Like you said, it's like the house hacking idea with a warehouse, where you got a big warehouse and now you're just partitioning it up into a lot of smaller pieces and doing the same thing that people are doing, renting out rooms. So,
Yes.
Anyway, I think that's an amazing creative solution to where you guys were at that point. So yeah, well, good on you for that. And question for you, I mean, you talked a little bit about kind of the why, but if you can go a little deeper into what your why is, I'd love to hear that.
Well, I'm going to depart from the regular as well, because my three daughters, Stanford, UC, Santa Cruz, San Jose State, they're doing great. They've got a couple of them got some great guys. They're entrepreneurial. If I didn't give them another nickel, they'd be okay. So, but one of the things that I really liked doing when I started getting profitable in my business is I love giving money away. I drilled some water wells. I outfitted a clinic, a medical clinic in India. I funded evangelical outreach. I just really excited about giving money away. And one of the things that I wanted to do is what's called a reverse tithing. So, tithing would be you give 10% of your income.
Yeah.
So reverse tithing means you live on the 10 and you give away the 90. And so in order to do that, I have to make a whole lot more money. That's literally my why. I want to be a reverse tither. There's some amazing people such as R.G. Letourneau, who was created most of the earth moving machines. And he did that. And there's other people who've done it. And that's my why. I want to make a ton of money and give it away.
Love it. I love it. I have made the goal, and I've expressed this publicly several times. I want to get to the point to where I'm a six-figure giver. I haven't switched the 90-10 around yet. But same philosophy is if I want to give away six figures every year, I've got to make more money. When I made that goal, my W-2, I was active duty military, but my W-2 was just paying me, low six figures to begin with. But so yeah, same thing. I gotta earn a lot more money to be able to give a lot more. And I appreciate you saying that. I think that's a very noble idea.
Let's see if I can
give away
pull it
90
off.
level 10. Let's see if you can pull it off.
I'm about 50-50 right now.
Yeah, I mean, 50-50 is still a lot better than most people. So I'm rooting for you. Let's get you to 90-10. Or I guess it'd be 10-90. Let's get you to 10-90. And hopefully we can help you out. But that said, I mean, we've got Natasha on the line. What do you want to ask her?
Wow. Well, I enjoyed listening to your story very much, and I'm very excited about that Huntsville property. That sounds like a dream. That's what we're all looking for. I guess the first question I want to ask you is, what do you think you could have known that would have got you moving faster when you started?
I wish that I had gotten involved with more networking groups. I definitely got involved with some groups, and I didn't go for like the bigger networking groups. I went for more of maybe the smaller groups, or it was also when I really got involved in it was more beginning of COVID. So it was sort of the groups that were meeting regularly on Zoom or what have you. Now that the world has opened back up completely to everybody at this point, I think more networking, more involving myself with other people that are interested in doing the exact same thing, that have very niche focus like we do, and multifamily, particularly value add type stuff, in the Southeast, even more specific. But that's probably what I wish I had done. Also, I mentioned it earlier, not necessarily following exactly what golden rules of investing in multifamily is, which is, finding an area where the growth is, 20% year over year, or population, jobs, and what have you. Definitely using some of those metrics to determine what's a growing market, what's a dying market, not necessarily sticking in just the large markets, especially just being as small as I am in comparison to, hedge funds and private equity funds.
Right.
So just being able to be a lot more competitive. I spent probably toward the end of 2020 till maybe halfway through 2021, just looking and underwriting deals in Tampa when I just was coming in like, I don't know, feels like 100K a door less than where they ended up selling. But
Yeah.
I spent a little bit too much time underwriting those deals.
I'll answer the same question. So I wish I would have done differently. I had this crazy idea that if you had a good deal, the money would come. I think I heard somebody say that, and I wanted to believe it so bad that I just did. It was just kind of like, okay, all I have to do is find a good deal and the money will come.
Mhm.
And what I realized is that's not necessarily true. You have to work on the capital raising side. But if I could just go back and change my mind on one thing, it would have been that. It would be that, yeah, finding a good deal is an important part of getting money to the table. But I think right now that my opinion, and people disagree with me all the time, but my opinion is everybody in this business should be raising capital at the same time they're doing their regular jobs. But like I said, I wish I would have started the capital raising train earlier. That's my 2 cents.
Those are gems, and I think that is important. I think I did have a little bit of that, the idea that if you find it, they will come. So I will lean into the capital raising more. And Natasha, you said something that fascinates me, because one of my questions, in addition to a follow up with regards to the networking, is I'm all about generosity and abundance mindset, and the mentorship program is very much about abundance. But how do you dive into networking when you're really networking with your competitors? Won't the same people that you're meeting, won't they be bidding against you in the same properties, looking for the same stuff? Like, how do you manage that?
Yeah.
I guess there's some that are, but a lot of the times I feel like real estate, and particularly this niche again, I think is like a team sport. So a lot of times just partnered up with a lot of folks and found ways to make deals work. We've done a few JV deals as well, not necessarily in our specific market, outside our market, but if we felt like the operator, the lead sponsor was strong and had the same values as us for various reasons, we've done deals like that as well. Unfortunately, I don't think the amount of multifamily investors are big enough in like these particular markets that I'm just like bumping into competitors, left and right. It's been people that are in the area or in the same market. I will say I actually purchased a property from someone who is a competitor, because we've bid on deals against each other, and we don't really have the same synergies to work together. But we're friendly. We go to dinner whenever I'm in the area. And funny enough, when I was in Tampa one time visiting, I went to a meetup, and the guy sitting next to me we happened to go to the same college and grew up a town away from each other. So we've stayed in touch these years, and we've done one deal together. We talk about other deals. Yeah, it doesn't always have to be straight competition, like you mentioned, the abundance, and there's plenty for everybody. So yeah, I like to keep that mindset.
I think most people do have the abundance mindset, and yeah, same as Natasha said. I have people that I know that bid on the same properties and purchase properties that we were outbid on. And a lot of times I didn't know at the time that they were our competition, but you find out later. You compare notes and you talk about it. But I would say that most people are more likely to partner with you. So that's actually how I found my first business partner. We were involved in a networking group, and we realized that we were putting an offering on the same property, and got on the phone with him, and we were kind of comparing notes. And at the end of the phone call, the other guy basically said, let's not compete on this deal. Why don't we just try to take this down together as our first deal? So I think a lot of people have more of an abundance mentality. Yeah, occasionally you do run into people you partner with, but if you're on these large network calls or these nationwide groups or whatever, very rarely are you actually directly competing with the other people.
Well, that's good to know. Sometimes when I didn't know there was such a thing as multifamily, and now I see it everywhere, and there's tons of groups and all these programs. And so I'm wondering, like, is there a glut? Is there still enough to go around? But you think that there is?
I think there is. I think just be aware of what other people are doing and what other people are looking at. And I think there's typically room for one more in a deal. So if you can provide value to other people, you're more likely to be looped into these deals than you are to be in competition, especially if you're working on building the relationships.
I love that. You talk about property managers as such a key component, and I keep hearing that. Natasha, how do you find a new property manager? What do you look for?
Yeah. So, I mean, I guess more recently, I've had to find one. And I will say it wasn't completely successful right off bat. It was a situation where we were actually purchasing two properties in the same town right next to each other. One was owned by someone we were buying it off market, and the other one was on market. And the one that was on market, he self-managed. It was a smaller property. And then the one that was off market, the sellers said that they had had a bad property manager, found a better property manager, had just switched over, like just the beginning of the time frame that we were under contract and going through due diligence. So we met with him. Again, it was a property manager based out of a larger city, and it was a 45-minute drive for them to come. There was also some other connection. He brothers with somebody that I compete with in another market. So there was some connection. We monitored it. We're very active. Every week we're on a call, constantly monitoring the certain work orders, anything that comes in. We get reports. We monitor it on top of just that once a week. So there was definitely questions about how it was happening. And I feel like I'm going off from your question, but
this is all interesting.
Yeah.
I went down a few times and stayed for long periods of time, went down surprise visit, not surprise visit. And, I think we both sort of rubbed each other the wrong way. He didn't like me being so involved. I didn't like that he wasn't getting it up from 80% occupancy. And so we kind of just went our separate ways. And while I was down there, I interviewed a bunch of other people, even considered doing some sort of hybrid situation where I would use my other property manager from distance and sort of almost like create like a quasi property management company and hire somebody locally to be at the property. We ended up not having to go that route, and we went with I guess they're a little bit of a larger property management company, but they have a larger, broader area that they cover, and they have no issue driving 45 minutes, and they're very on top of it. And we're 100% occupied, and we're going to start raising our rents again after the holidays. So it definitely is. Because of that also, I'm also very on top of making sure I have a good property manager. But currently, after that debacle, I'm really focused only in that one market where I have a strong property manager. So I really have to interview them anymore. But, a lot of the questions of I guess right away, I know if somebody's going to potentially a good fit if they don't have any problems with me getting on a weekly call with them. A lot of times when they don't want to do that, then I kind of
red flag.
Yeah, red flag. Yeah,
it's hard is the answer. I mean, it's just hard. And we've cycled through, half a dozen different property managers. Every property manager knows what to tell you. Oh yeah, we can do that. Oh yeah, we can do that. Oh yeah, we can do that. I've started to look at property managers more as like dating. You date one and you try them out for 3 or 6 months, and if they work, you keep them. And when you find one that you like, that's my opinion is once you find a property manager that you like and they do a good job, do everything you can to keep them happy. Is kind of how I look at it. And Natasha, sounds like you found one that you guys really like, and they fed you properties, and you guys have this really symbiotic thing going on. But yeah, my opinion is you date, and you let them know from the beginning, hey, we bought this. This is a new relationship. Let's try this out for 6 months, and we're going to reevaluate in 6 months, see how things are. And once you get through that honeymoon period, you're probably going to know whether or not it's worth keeping that property manager or not. Much different answer than I would have given you a year ago.
Interesting. So then what about when you looking at a property, would you interview a new property manager as you were looking at a new property?
If it's in a different market, yeah, I would. Also, not something I probably would have done, a year ago, but now if I found a new market or found a property I thought was really strong, I would make sure that I had a solid property manager in that area before moving forward with the property. One other thing I just want to mention too about sticking in the area that I'm in and with the property manager that I'm using is it also provides an economy of scale, because there's property management fee will go down. But also in addition to that, we have staff, we have other services that we can use across all of units. So that's also really helpful with, having a strong property manager, being in a particular area and growing a portfolio there. But again, if I'm hoping in the next, I don't know, year or two, whatever the time frame is, that there's a lot of great opportunities coming across because of where the economy and what have you is going, that potentially we will be looking at markets outside of where we're looking right now. And if they come across, I would have to make sure the property manager in that area is going to take care of us. I mean, I probably wouldn't not put a LOI out, but once I did, I would probably want to find
Ideally, and now thinking of just what's ideal, ideally you have a property manager in place when you put the LOI out. I agree with Natasha, not having a property manager picked out is not going to prevent me from putting an LOI out. But if you look at what's ideal, you have a property manager picked out, they're good to work with, and they can help you with the LOI, they can help you with the underwriting. But on the flip side, if you're going into a new area, it might be difficult to do that. So once you get a property under contract, that's where nailing down a property manager needs to become a priority.
I'm not afraid of interest rates. I remember Jimmy Carter, it was 13%. But what are you doing differently now as interest rates are creeping up?
For the short term, like right now, I'm looking at properties that are seller finance because of that, and locking in a rate that's reasonable for me. I'm finding the sellers right now are still expecting the prices when rates were 2-3%. They haven't really adapted, especially in these smaller areas where they're kind of like, oh, well, I didn't pull the trigger for the last 2 years, but now I want the same price that my neighbor got. So I think that will catch up. Like you said, there's been other times in history where rates have been higher. So hopefully we don't get that high, but that's something that I'm looking at.
We got one property under contract and we're assuming a loan at a 3.4%, which is, and we're selling 3 right now. 2 out of the 3, the buyers are assuming our loan. With loans being where they're at, if you can find a seller who's got 3 to 5 years left on their loan term and their rate begins with a 3, 4, or 5, you're probably better off assuming a loan right now than getting a new one. So that's one thing. I think that's probably the easiest answer. I mean, seller financing, if you can get it, is probably best answer, but there's not a lot of sellers that are willing to do that. In tertiary markets and on smaller properties, the answer is absolutely. There's a lot of those.
We had the same thing. We had a property under contract that was a loan assumption, but the only thing was the LTV was lower. That was the only thing that sometimes for me wouldn't necessarily make it price out, as long as the seller's willing to price it right. It's a good option.
On the loan assumption that we're buying, we're going to come in at about 65% LTV. So where we are in the market right now, I'm actually very happy with that number. I mean, 65% LTV, that is safe, and we've got 6 years of runway before the term's up. So I think it's a very safe investment for a lot of people. So it doesn't work for everybody. I mean, the lower LTV, the more capital you have to bring to the table, the more
bigger
returns you get. Yeah, exactly. But in certain situations, it works out. Anyway, that's about it. We are out of time now. So one last question for each of you. Natasha, you get to go first. How can listeners learn more about you?
Yeah, so my company is called Radlett Capital, RADLETT Capital. And that's our website. That's our Instagram and LinkedIn.
Okay, so we'll put links to that in the show notes. But if you're looking for her, Radlett Capital, you can probably just Google it and find her. But we'll put links in the show notes as well. Martha, same question for you. How can listeners learn more about you?
Yes, I also have my brand is a Pavilion Multifamily. Pavilion, like a big tent. pavilionmultifamily.com, and also on Instagram and LinkedIn.
All right. We'll have her information in the show notes. So anybody who wants to contact either of these two ladies, that's all you got to do is hit the show notes, tap the link, and that internet thing will whisk you away to their websites or social media profiles. So thanks very much for coming on the show today. Very much appreciate your time. A lot of really good gems came out today, and appreciate you both for that.
Thanks.
Thank you, Natasha. Thank you, Brian, for providing such a great platform.
Thank you.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.